Okay, hey, listen, everybody. It's Kurt Frankenberg at RadioActive Trading, and I'm joined today by my good friend Mike Chepka. And I'd like to just do a brief sound check and a little tiny bit of a get to know you. Okay, just a sound check. If you can use your question pod to answer this question, can you hear me? Can you hear me okay, folks? Okay. We've got some answers pouring in. Ray says yes. John and another Ray say yes. Wow, we got 3 Rays. Look at that. And then Gunter and David and Greg and Jim and Ron and Arnold, Michael, Kelly. Welcome, everybody. Yes, sir, says Kelly. Thanks for that. And then Ted. Very good, folks. Okay, we're expecting a couple of hundred folks on the line today. So I wanted to make absolutely certain that y'all could hear me okay. And very good. We're going to start here. I guess it's 2 minutes past the hour, so we probably should get started right this second. So Mike, let me jump in here.
There you go.
Okay, good. Are you seeing my screen there, buddy? You are? Okay, good. Okay. Well, we've got 76 slides, so I've got to make this introduction short and sweet. My name is Kurt Frankenberg. I teach options trading, but I also teach martial arts. I've been doing that as my primary career for 25 years as of the 1st of this month, April 1st. Everybody thought it was a joke, you know. They thought that, oh, okay, an 18-year-old kid is going to own a martial arts studio, but it's the truth. And I've been running it ever since. Along the way, I started investing and got really badly hurt by not understanding the principles of leverage. And I ended up going back to school, sort of, and learning how to protect myself against downturns in the market while leaving the upside open. And that I now teach. And Mike, you're the options director at at Power Options. And why don't you tell me a little bit about what you do over there on the East Coast?
Well, I'm the Director of Education here at Power Options. Power Options, of course, is a patented suite of search and analysis tools. We support over 23 different option strategies. My job is to instruct customers on using those different strategies and using the tools to implement those strategies. And I got started in options investing in a similar fashion as you, and probably as most of our attendees did as well, learning covered calls and then branching off in the naked puts, which is a parity trade, and then calendar spreads and so forth. And eventually I went into collars, even though no one was really advocating standard collars, because I was having a problem minimizing my losses with stop orders and other popular techniques with just the covered calls, the naked puts, and the leverage spread trading as well. So I started to look at limiting my risk more with just the standard collars. And about 3 years ago, you had called up to find out how to use the Power Options tools and the historical suite of tools to sort of do some back testing on ideas you had for radioactive trading. And when you first showed me your initial setup, I thought, well, I don't see how you're going to make a lot of money with this, Kurt, because the way you're setting this up looks like you're going to need a very large stock movement in order to make any profit. And you said, well, why don't you come and join me for my free webinars I host during the week, and I'll show you exactly how I make money with these positions. And I, of course, was so impressed with it that we had Ernie Zarenner, the president and founder of Power Options, join me for the next couple presentations. And he was so impressed with it that we decided to partner up with Kurt and enhance our married put tools and our portfolio tools on Power Options to work with your techniques, your specific techniques. And both Ernie and myself and the other staff members here at Power Options have been trading radioactively in our accounts for the past 3 years now.
Very cool. And have you been pleased with those results, Mike?
Yes. I mean, I've had some positions where I was long stock the entire time and watch a stock drop down about 75% from where I purchased it, but I was still able to close the position for a profit. And I've had other situations where I probably doubled the potential return I would have by just doing standard covered calls, even rolling the covered calls over the same time frame. I was in the radioactive position because my upside was unlimited.
Very, very cool. Okay. Well, super. Folks, our room has filled up to the point that I think we are ready to go. And what I'm going to do is set just a couple of ground rules because we're expecting hundreds, plural, of folks on the line. Mike is not going to be able to handle all the questions, okay? That's actually okay, because guess what? We have anticipated, Mike and I have been doing these presentations for a number of years now, we've anticipated most of the questions that you're probably going to have. And so we're going to, we've actually made that a part of this presentation, okay? But if you are thinking and think of a question and you jot it down, all right, if we haven't answered it by, there's going to be 2 stopping points, okay? If we haven't answered it by those stopping points, please feel free to pose those questions then, okay? All right, so Mike, let's dive in. Here's what to expect today. I've got 75 slides to go through, and we're going to try and spend less than a minute on each one, okay? So it's going to be an hour and 15 minutes. We're going to be done at about 1:15 Eastern Time, okay? It's going to be 97% education, 3% promotion. Yes, I've got a book to sell, all right, and I've got a subscription you might want. Mike, have got the subscription to Power Options, which folks might also want, and we're going to just be able to display a tiny bit of those things. But my main aim today is to help folks to make money. And what we're going to do is spend 97% of our time showing things that do just that. It's not one of those things where it's just a taste and then we tease you. I've actually been told, hey, Kurt, you need to show less. You need to build up more curiosity. You need to, you know, this is by marketers. They're telling me, you give away too much for free. And I say, well, you know what? The blueprint has got a lot in it. so we're really just showing the tip of the iceberg. Would you agree with that statement there, Mike?
Oh yeah, the blueprint is a very large book. People are usually surprised by the size of it when they first receive it after they've placed their order. And they say, okay, well maybe there's a lot of fluff in here. And as they start going through it, they realize, no, this isn't a lot of fluff. This is actually usable material that I need to know if I'm going to implement this technique. And it's discussed in there, of course, how each of those techniques and each of those processes will help you enhance your returns and still limit your risk.
That's right. Folks, we're going to learn the biggest problem that faces traders today, and we're not just going to talk about the problem, we're going to talk about the solution, okay? You're going to learn a simple tweak that will drastically improve your trading. It will drastically improve your trading overnight.
Mm-hmm.
And I can back that claim up because, listen, we're going to do a poll at the beginning, and then we're going to do another poll later on. The first poll will do kind of a baseline reading of where your trading is at. We're going to show you a simple tweak, and then after that simple tweak, we're going to have you estimate what kind of impact that would have made on your trading account if you'd been shown it a year ago. Okay, and so we're going to back that up. Then after that, we're going to show 3 spread trades that either take money now or guarantee more in the future. Okay, either one, but are done with 0 risk, and that's a pretty big claim. Mike, I know there's some spread traders on the line, and they'd probably be very interested to know, how do you do a spread trade that takes a credit or that guarantees a higher return without any risk? Okay, pretty cool. So if you're a covered call trader, okay, you're never going to want to do it the old way again. I'm going to show you one way to potentially do a lot better than with a covered call, and kind of take away that pesky problem of capping your upside. Right? And if you do spread trades, the spreads with 0 risk is a real super, just, you know, if you understand spread trades, you're going to really dig what I have to show you today, okay? All right, so Mike, we're going to need to learn a little bit more about our audience. We're going to do poll number 1, what's your involvement with RadioActive Trading, and poll number 2, what options strategies are you using right now? So let's make these polls really, really fast. Oh, one of the other ground rules I was going to say is, hey, pay attention, because I'm just going to leave these polls up for 30 seconds, okay? We're not going to leave them up for a minute like we used to, because we've got so much material to gain. But I want everybody to be able to participate, okay? So let's leave it up there. That's 15 seconds up so far. We've got a lot of participation already. Thank you, guys. I'm going to leave it up for only another 10 seconds. All right, so let's get her figured out. All right, and 3, 2, 1, close. I'm going to close that poll. Share the results just briefly. Okay. The winner is, I've been coming to webinars, and that's good. I'm happy that you do come to these free options trading webinars. Okay, second place just got the sketch. Listen, the 29% that got the sketch, I'm going to say make that 100%. That's a free white paper. It's available on RadioActiveTrading.com. Really good material. Some folks have told me, many folks actually have told me that they have gone on and bought the blueprint based on the profits that they made just from following the directions in the sketch. Okay, in fact, that used to be my little sales play. Was I said, hey, look at this sketch. If you like it, after you make enough money or save enough money by applying the principles to completely offset the cost of the blueprint, go ahead and buy. And that used to be my little sales close. Okay, nowadays folks would rather get the information, sir. But all right, 27% thinking about buying the blueprint. We've got 2% that already own the blueprints. I'm glad that you're here reviewing the basics. So that's marvelous. Okay, let me hide that, and we're going to run poll number 2. Poll number 2 will give Mike and I an idea of what kinds of options trading strategies you're doing now. And many of the polls are for Mike's and my edification. It's so that we know who we're talking to, so that we know how to pace and work the presentation correctly, okay, and what things to emphasize and what things maybe not to emphasize. But many of the polls are instructive, including that baseline reading that we talked about. Okay? All right, that's 30 seconds, man. Let's close it and look at the results. Okay, 3% say nope, it just changed at the last minute. 2% say options me no likey. Okay, so for those 2 people, I'm going to say that the reason that folks that don't like options, the reason that they don't like options, there's only 2 reasons. One is they just haven't gotten into it because of not understanding the jargon or whatever. But remember, there was a time when you didn't understand what it meant to be long stock. There was a time when you didn't know what a stop order was, right? There was a time when you didn't know a lot of things about trading. So education is the key. Now, the other reason that somebody would not like options, the other reason is that perhaps they learned just enough to get themselves into trouble. And that was my case, Mike. And I could have continued to say options me no likey, but instead I decided to learn a little bit more, and I found out that options were indispensable to limiting risk, to keep you out of trouble if you use them correctly. Okay? All right. Our winner today is long calls and puts. Our second place winner is spread trade. That's marvelous. We've still got 59% doing the gateway drug there, Mike, the cover calls. All right. That's how most folks get involved in options in the first place, is trying that. And then, of course, we have some folks that are sophisticated enough that they do naked calls. Wow. I don't do those simply because I can't control the risk in them. Okay. So here's the deal, folks. The 2 biggest problems. Remember, I said you could expect this. I was going to pose the biggest problems. Okay, the 2 biggest problems. Actually, it's only one problem, and the problem is we don't know the future. And then, of course, everything that relates to that is the fact that our decisions can only be made in the present. Okay, we can't make our decisions in light of what the market has done, at least in most situations. Now, with radioactive trading, you can actually make decisions in light of what the market's already done, so that's kind of cool. But the biggest problem facing most traders is that you don't know what the future holds, so therefore, your decisions in the present are dictated by the forces, mental forces of hope and fear. And too often we fear when we should hope, and we hope when we should fear. Mike, there's a saying up there, okay, the beginning of the saying. It says, cut your losers short. I know that you know the end of that. I wonder if any of our audience knows the end of that, okay?
Well, I'm sure they do.
Saying. Go ahead and text that in there, folks, if you know the rest of this story here. Cut your losers short, and there it is. Let your winners run. Let your winners run. Thank you, Steve. Okay? All right. Cut your losers short and let your winners run. Now, that's a nice trite saying. It kind of reminds me of another trite saying. What's that other trite saying, Mike?
Well, buy low, sell high. Simple, principle, easy to put into practice.
I'll do that. I'll just do that. You know, I actually heard that when I was in grade school, and I thought, well, geez, you know, when I grow up and I'm an investor, I'm going to do that. I'll just buy low and sell high. Another Steve wrote in and said, sell high, buy low. Okay, and that's certainly true too. You can short the market and sell high and buy low. All right, but here's something that's really important. This saying here, cut your losers short and let your winners run. Most folks recognize that that is actually the key to trading, but then as far as putting it into practice, that's a different story, okay? So question number one, do you always do this? Well, I used to not, okay? I used to not. All right, but now I do, and here's why. What if you could guarantee that you would always do this? What if you could set yourself up in such a way, Mike, that was basically how your trade was made? You know, it didn't have anything to do with your orders that you place. It wouldn't be a stop order, for example, or a one cancels other order or anything like that. It was just the way the trade itself was set up. What if you could guarantee that you'd always do that? That'd probably be useful. Now, Mike, what I'm showing here is a graph of a stock that I traded, and I think you traded this one too, or did you trade something like it? Did you trade
No, I traded a similar stock. This is XL Maritime Carriers, excuse me, that you traded. And it's one of those volatile Greek shipping stocks. And we saw a lot of profits at one point with these potential stocks, and we saw a lot of losses later on. I was actually trading dry ships and Diana shipping at the time that I think you were in XL Maritime Carriers.
Okay, and were you trading dry ships radioactively, or were you doing
it? No, I got really lucky with that one. I'm going to be dead honest. I bought the stock without protection on it, without the radioactive trading technique. I think this was right when we first started getting together. The stock started to move up so quickly that I couldn't even, I was going to do just a covered call or a collar, but the stock moved up so quickly from when I bought it that I could never find a proper strike price to sell a call. So I just let it run over the course of 4 or 5 months, and it worked out very well for me.
So almost by accident, you applied the principle, let your winners run, right?
I'll be honest with you, even though I've been in the industry for 8 years, a lot of times things like that is pure luck. Yes, I did some research and analysis. Yes, I had a sentiment of where the stock was going, but I could have given back those returns at any given moment on one of these volatile stocks. And you can see that in this chart. You see many valleys where you could have bought the stock low and then peaks where you could have sold it high. But at some point, that first bottom you see, if you bought it then and then it had that double top there, well, if you didn't get out of it then, you got right back to break even a couple months later. And then it shot back up, and then, well, maybe you missed that, or you got stopped out of the position at that point. That's the tough thing, is we don't know the future.
That's right. And looking at this chart, okay, you would think that I would have had to have traded this with some kind of inkling of what was going to happen next. Mm-hmm. And the fact is, I didn't. But I got into this stock, Mike, and at no point could I have lost more than about 5%. And it's not because of the trailing stop or anything. It was because of the fact that I had a put option in place. But the good news is that 3 weeks in, I had done a riskless spread trade, actually 2 riskless spread trades that made me bulletproof. You know, the combination of those 2 riskless spread trades made it so that I could not possibly lose, no matter what the stock did after. And 3 more weeks later, I got out with a 6-week 10.22% gain. But again, it's not the 10.22% gain that deserves the attention, even though that sounds like, hey, that's a good gain. That's not what deserves the attention. What deserves the attention is the fact that for 3 weeks, I was sleeping very easy, knowing that I couldn't lose. I only had to hang on and wait to see how much I was going to win. Mm-hmm. That was it. And for the first 3 weeks, I could not have lost more than about 5%. Okay, so flip a coin all day long. If you lose nickels and make dimes, that's the key to success. Okay, in trading. Okay, so we let the winners run and cut the losers short. Okay, real quick poll here, Mike. Are you happy with your trading results? Now, folks, if you met your expectations last year or you beat your expectations, you ought to be happy. Okay. If you lost money, I understand that's just cause to be unhappy. But probably a lot of folks are going to end up in the middle there, where they had gains but just didn't feel like it was enough gains. So you might have mixed emotions. Okay. And so let me run poll 3. Okay. And looking back over the last 12 months, okay, how happy are you with your trading results? And again, 30 seconds, folks. Okay, I know it's been a few minutes since I hit you with a poll, okay, but you've only got 20 seconds to answer this one. Let's get in there. Please make your voice be heard. I'd like to hear from everyone that was successful, everyone that was unsuccessful. This is looking like a bell curve, isn't it, Mike?
And yes, we've been noticing that the past several months here.
Right, I'm going to close this poll and share the results. And wow, how about that? The moment that I did that, everything turned into even numbers. Do you see that?
I got it. Yeah.
Now I'm really surprised that there is no representatives in either end of the spectrum. Usually we have at least a few saying, yes, I made piles of money, or my results sucked, I'm ready to throw in the towel. Okay, but we didn't have anybody answer those. But 40% say I'm happy, but I could stand to be happier. All right, so I'm gonna congratulate y'all. That's marvelous. Okay, that you were happy with your trading results, and of course we could always stand to be happier. That's a given. 50% mixed emotions. I've won some but lost some too. And 10% are definitely unhappy. They would rather, my radio producer said this to me one time. He said, man, I would rather take a physical beating than a financial one. And I thought that was kind of cute, so I put that in there. Okay, but Mike, we've got 40% saying happy with their trading. That's actually a very high number. We usually see it work out. Those first two results, we usually see those first two results totaling 20. You know, maybe 3% say, yes, I made piles of money. 17% say, I'm happy, but I could stand to be happier. And then the other 80% end up in the lower three answers there. So anyway, I'm glad to see 40% that are happy with their trading. That's great. Now I'm going to show you how to be happier. Okay? All right. But before we do that, we got to figure out what the problem is. We actually have already figured out the problem, but why has the problem not been solved? The problem is that we live in the present, okay? And we don't know, we can't know the future, all right? And so the decisions that we make in the present are always shaded by our hope and our fear, and we should fear when we should hope, and we hope when we should fear, and that's the problem. Why has it not been solved? Okay, well, some folks know that they've got a problem, okay, and some folks are unhappy with their trading results. 60% of the people on the line today are plain unhappy with their trading, okay, and 40% were happy, correct? 60% right. Had mixed emotions, were not happy, okay, and 40% said, I am happy with my trading. But few know exactly where to start. What do you think the solution would be for you? And I'm going to give 5 choices. What do you think the biggest problem is?
Well, yeah.
Okay.
What would solve your problem? What would solve your...
If I could wave a magic wand, yeah. And you can only choose one of these. You can't choose multiples. You can. So I want you to read through this list. Take the whole 30 seconds to read through the list, and then go with your gut. Okay. If you think I need to wave a magic wand and give you more time in your day, go ahead. Okay. If you think that I could show you how to always pick winners or pick winners more often. Okay. If you think your timing is bad, or if you think, geez, you know, I wouldn't mind losing some if only when I lose I didn't lose too much, right? or I need for my winners to win more, okay? And you say leverage, right? So, oh, oops, I've left that up for 48 seconds. Let's share the results right now. Bingo. Okay, Mike, what's the number one answer? This is interesting. We've got representatives in all 5. What's the number one answer?
Well, I wouldn't mind losing some if I could limit my losses a lot. If I could keep my risks down, I could suffer some losses and I'd be happier on my trades.
That's right. Okay. Now, it's interesting. There's only 6% want to spend more time with their trading. And I think that I'm with them. Okay, I'm sorry, I'm not with them. I think I'm with the 94% that don't want more time to trade. That they figure that, man, I don't want to sit in front of a computer screen all day long. It doesn't sound like my idea of fun. Well, that's not my idea of fun either, and so I don't. I'm not constantly in front of my computer. All right, but for 6%, they think that might be the deal. Okay, 28%. If I could pick winners more often. All right, well, is there a formula? I don't know it. Maybe Warren Buffett does. I couldn't tell you. My timing is bad. 9% is really the only thing. That is interesting because a lot of times we see a pretty high result there. A lot of folks, their hot button is, I want a stock timing system. I want to know how to read charts. Today, less than 1 out of 10 said that. How about that? That's interesting. Okay. Well, folks, those last two categories there make up more than half of every down the line. Wouldn't mind losing some if I could limit losses, and I need for my winners to win more. I've got a solution for those. Okay. I've got a solution for those. So, and I think that you'll actually find that it's the solution for everyone, what I'm going to show. All right, so let's get started here. Okay, all right. Cut your losers short, let your winners run. I got a question, Mike. Does the idea of selling covered calls or selling naked puts go well with that?
Not exactly, because a standard profit and loss chart of a covered call or as a naked put, they're parity trades. You see a position where you have a limited gain, but you're still taking on 95, 96, or 97% risk of owning the stock outright. So it technically cuts your winners short, and allows your losers to run.
That's right. On Tuesday, Mike, you weren't able to join me last Tuesday, day before yesterday, but somebody wrote in with all caps. He says, no, it's just the opposite. Selling covered calls can limit your profits if that stock is a winner. It'll sort the winners out of your account, but it'll leave the losers in there. And so that's no fun. What about vertical spreads, butterflies and condors? Okay, these are spread trades or combination spreads that are pretty commonly used by spread traders. These things that fly, butterflies and condors and so forth. Okay, do they let winners run, Mike?
No, they still have a fixed maximum gain. You still have a hockey stick chart where you have a maximum return if the stock goes in your desired direction or stays at the relative price. So you can't have outsized gains if the stock moves up one direction or moves down one direction.
Right. If your stock was a runaway winner, that'd be a bad thing if you had a condor in place, wouldn't it?
Yes, if you had a condor or a butterfly, or if you had a bear call spread or a bear put debit spread, if the stock took off, you'd have a very high leverage risk. You might be losing 10 times or 5 times more than the potential premium you could have made.
Yeah, not cool. Okay, so again, it has to do with being right more often. Well, Mike, I'm going to say, I'm just going to pick on the covered callers here for a minute. Okay. This piece of propaganda is not from my site. This is from an educational site that talks about the covered call. And the reason I call it propaganda is, look here where it says the risk is safer. If you sell a covered call and you bring in 3% premium, and it's on a very volatile stock, have you really hedged yourself effectively?
Well, you've hedged yourself maybe by 3%. But in essence, you still have 97% of your capital invested at risk. And then everyone says, well, you can use stop losses or there's trailing stops that you can use. Yes, but in a sudden gap or in an unexpected event, a black swan event, you're still taking the risk, 97, 95% risk of owning the stock outright. Right.
And another thing, too, is that you have to sit on it. If you set yourself what do you call it? If you set yourself a stop loss order, will most brokers allow you to get out of the stock and still have the short call in place?
Not exactly, right?
Not without a very high trading clearance, and not without putting you at actually potentially even greater risk. So this is really not a solution. Okay, it's actually the opposite of what I believe the solution to be, and that is to set yourself up in the first place where you cut your losers short and let your winners run. How about that? Mike, the expectation on this is bullish, same as it was with the covered call. If you remembered from the previous page, the covered call trade was bullish, and that's true because the biggest component of a covered call is the ownership of the stock. You do expect your stock to be a winner. Okay, so that's the expectation is bullish. The risk level, I'll go along with it now that it says safer, but what about the reward? Is it limited or unlimited?
Well, our reward now is unlimited. That depiction is correct. We have an unlimited upside profit potential, and our risk definitely has been limited.
Right. Now that's not a guarantee. It's just potential. Okay, but I'm going to say that it goes up and down. It goes both ways, that the married put is going to perform better than any other strategy. And I'll back that up with numbers. Okay? All right, so what's possible? Well, let's talk about that. The structure of a radioactive profit machine is different than a standard married put. A standard married put, well, why don't you describe that, Mike? What's a standard married put look like?
Well, typically, if you've read any information at your broker, any free education, options education, a married put or protective put is typically described as buying shares of stock and then buying an out-of-the-money put, a put that's below the current stock price, maybe only 30 or 45 days out in time. So maybe you're only paying 50 cents, 60 cents, or 70 cents for protection. But the problem with buying the out-of-the-money put and buying an option month by month by month is that you're increasing your annualized return, and the stock still needs to fall 10, 15, maybe even 20% before the insurance policy kicks in. So you're still risking an unconscionable amount on the position.
Right. I think you meant annualized costs, right? I mean, if you...
I did. I'm sorry. I meant annualized cost. My apologies.
That's all right. What Mike is saying is that if you pay for a put every month, okay, you pay for a put that's a month out every month, you're going to spend a lot more than if you pay for one put that's 6 months out in expiration. Okay, so that's one way to save money. The other thing is I go in the money. Okay, instead of going at the money or out of the money, I go in the money. See this here, Mike? This is an actual trade I did back in September of 2010, holding Altera shares at $27.35. I went in the money and bought March $29 puts. And see, it's September, but I'm buying March. So that's what, 6 months away, 7 months?
Right, just roughly about 7 months.
Okay, here's the deal. The total invested amount is $30.85, but because I'm holding a $29 put option, I've got a very, very tight stop. It's not actually a stop order that gets violated and gets triggered without my input. Okay, it's a legal and binding contract that can get me out. So what's the at-risk amount? Well, the at-risk amount is the difference between the $30.85 and the $29, or $1.85. And $1.85 per share, when we're spending $30.85 on the shares, is 6% of your underlying investment. Okay, now I know. What did you say to me when you first saw this structure about 3 years ago? What did you tell me about that?
Well, Kurt, I don't get it. I understand that, yeah, you've limited your risk down to 6%. That's great. But look, you're not going to make a penny until the stock's trading at $30.86. I mean, we're talking about almost a 12 to 13% increase in the underlying stock price before you realize a profit. I mean, wouldn't you be better off just, if you were expecting that increase, just to buy 2 or 3 shares and let the stock run, or 200 or 300 shares and let the stock run?
Right. That is the knee-jerk reaction that a lot of folks get when they see me spending this much on insurance. I mean, this is more than 10%, about 15% of the underlying investment I'm spending on insurance. Okay, but guess what? We spend money on insurance for other things. Why shouldn't we spend money to protect our money? I think that only makes sense. Well, take a look here. We've got $30.85, and some folks have told me, Kurt, you're not going to make a dime until the stock goes to $30.95. And Mike, efficient subscribers were watching as I took Altera using the income methods, actually the same income methods that I'll share later today. Okay. I took the income methods and locked in a 75% share profit, and that doesn't mean I reduced the risk by 75 cents. I locked in a profit with Altera at only $29.40. Okay, so it didn't go to 30.95 yet. I locked in a profit to where I couldn't possibly earn less than 75 cents per share, and that's holding 500 shares, by the way. Okay, and then I was bulletproof. Okay, meaning that no matter what the stock did, I couldn't possibly lose. Okay, and yet it went on. Whoops! It went on to make 12%. Now, yesterday I had somebody write in to me, and he says, "Now, Kurt, you're not factoring in commissions," and that's true. It makes it cleaner for me to show the numbers, and all the numbers that you're going to see today I'm going to leave commissions out. Okay. But the fact is that commissions did cut into my profits here, Mike. I did not make 12% per se. I made 12% less the commissions. I paid a commission to buy stock. I paid a commission to buy options to protect it. I paid commissions 2 times when I did 2 different spread trades, and I paid commissions when my stock got assigned. All right, so all those commissions added up to about 0.1%. So I have to be truthful and then say, look, you know, it wasn't really 12%, it was 11.9. So is that all right with you?
Yeah, and the other thing is that I understand the question, and you want to make sure that, you know, everyone's, you know, you want to make sure that the information that you're receiving is accurate and is in detail, and I understand that question, why the attendee would have asked that. But in anything, if you're just comparing straight strategies, you're always going to have commissions. If you're doing covered calls, you're going to have 2 commissions. You're going to have to, if you're comparing it to rolling the call, well, you're going to have another commission. Those are always going to be factored in. And it always works out to be about the same. It's not that this is increasing commissions by a drastic amount. Every options technique you do, well, you got to pay the piper for the right to do it. So it's always included. I mean, it's always in that thought in the background that the commissions will be about the same regardless of what strategy you're doing.
Right. Yeah, and everybody knows what their commissions are. Okay. You know, so rather than discuss with you all that and getting into a major discussion about, well, gosh, which broker should I use? You know, I happen to use Options Express. They charge me $9.95 for almost everything that I do. Sometimes a little more, but anyway, here's the deal, guys. Yesterday I showed this. This is April 20th, 2011. I did not do any income methods on it. I picked up eBay shares at $31.70 and in October 2011 $34 put option. So it's almost the same kind of trade here. 6 months away. It's in the money. I've got a guaranteed exit, and guess what? My risk is about 5.4%. All right. So, pardon me. This is that simple tweak that I said at the beginning was going to revolutionize everybody's trading. Okay. Now I haven't shown the 3 riskless spread trades, and I'm going to. Okay. But I don't want you to take my word for it that limiting your risk in the first place is the way to go. All right. I want you to take your own word for it. We did a baseline reading before about how happy folks were with their trading. And looking back over the last 12 months, let's just do a tiny tweak. If you had kept your wins, I'm not even saying enhance your wins, which guess what? If you're a covered calls trader, you will enhance your wins, all right? I promise, because you leave your upside open. Right? I've done a number of treatises and YouTube videos on that. So just comparing a winning covered call trade with a winning Mary put trade. Okay, but anyway, if you had kept your wins, not enhanced them, but just kept your wins and limited your losses, from whatever they were to 6% or less in each individual trade, would you be happier? And oh, by the way, Mike, I do diversify. So what I'll do is maybe there's 6% of my money in a particular trade at risk, right? But out of that money, it only happens to represent 1% of my total portfolio. Does that make sense?
Well, let's put it this way. Yeah, let's say we had $100,000 in our account. Well, that position that you opened might have been, you know, was it $1.95 or 6% from the Altera position?
Let's go back and look at it. Yeah.
Okay.
Okay.
So
go ahead.
With that $100,000 account, if I know that my total monetary risk is $1.95 per 100 shares, for example, or $195 per 100 shares, then you wouldn't want to trade more than 500 shares, for example. That would represent...
Okay, so 500,
yeah, go ahead.
500 shares and 5 puts just scaling this, 500 shares of this and 5 puts would risk $1,000, so that'd be 1% of your portfolio if you had $100,000 to trade. Okay, so we'd have 5.4% at risk in this, and we'd have 1% at risk of our total portfolio. Okay, so here's the question. All right, if you kept your losses down to 6% or less in an individual trade, or 1% of your portfolio, okay, how would you have answered in that first poll? Would you have said, yes, I'm very happy with my trading results? Did you say no or mixed emotions, but would have said yes? Okay. If you had a losing year, but this tweak would have made it a winning one, okay? Or I still would have lost, but I would have lost much less. Or can you honestly say, I never had a loss over 6% or 1% of my total portfolio, but I still had a losing year? Can you say that? If you can say that, please go ahead and put it in. All right? That is possible, isn't it, Mike? I mean, it's possible.
Yes, we've been doing it for, you've been doing it for about, yeah, you've been doing it for about 8 years, and I've been doing it for about 3 years.
Yeah. Well, what I mean is it possible to limit your losses to 6% and still have a losing year? That is possible. It could happen. It just doesn't very often because you stack the probability on your side. Okay, so let me go ahead and close that poll and share the results. I actually slipped and left that up for a minute, but let me share those results. Mike, we had 40% say I'm happy with my trading, and 60% say either mixed emotions or no, I'm very unhappy with my trading. Now we've got 50% saying yes, I'm very happy with my trading. 79%, I said no, but this would have put me in the yes category. 5% said I had a losing year, this would have made a winning one, and 13% said I would still have lost, but lost much less. And so 97% would have done better over the last 12 months with this approach. Okay? Now, let me address the 3%. If 3% of you never had a loss over 6% or 1% of your total portfolio in a single trade, and you still lost overall last 12 months, you are doing something wrong. And I will say that this is it, okay? What you are doing wrong is you are day or swing trading. I'm going to say that with authority because I've been doing this for 9 years now, counseling people with this kind of information, and the only folks that ever are able to make that claim are folks that are not using a long enough time horizon to let their winners run. You know, if you cut your losers short, if you were able to completely limit your risk down to 6%, but when you happen to have a winner, it went on to 20, 30, 40. Mike, you see me make 40% in trades. You see me make, you know, you made last year, you made 59.8% in one of your trades, right?
That's right. That's exactly 59.8%.
Right, and you were bulletproof for most of the time, meaning that you couldn't possibly lose anything. At the very beginning, I think you had 7% at risk.
It was 7,
right?
yes,
6,
that's right, 7.
You had 7% at risk, and over the period of time that you traded that, 1 month in, you were completely bulletproof. So here's the deal, okay, folks. Let's recognize that I've just paid for your options education for the year. Okay, let me hide that, and let's move on. Okay. Oh, you know what, Mike? I've got to put a dollar amount on that. Okay, I got to ask everybody to put a dollar amount on that. That'll be our 6th poll. We've only got 2 to go and a lot of instruction to do. We've got still about a half an hour. So I'm really excited. It sounds like you're typing furiously, and so maybe some folks are asking questions. You know what? Maybe we should allow a few questions right now.
Well, we are at 12:45. I was just having a conversation with a customer who was commenting that the market has been in a severe bull market, so covered calls have worked well. The problem is that what do you do when the market is not on a bullish tear? And I was just discussing, well, you know, a lot of customers would have had a great year. A lot of investors had a great year of 2010, 2011, doing just covered calls in the bull market. They didn't let their winners run per se. They could maybe roll the position, but still, that's not letting the full winners run, for example. But I have several customers. I know several investors, and I've heard them over the past 2 or 3 years, that They had a better than average 2007, and they maybe even had a fantastic 2010 to 2011, but the losses, they're still not back from the losses they took in 2008 following their techniques, because it just got away from them so much so fast.
Right. You know, it pays to have the marbles to play the game, right?
Mm-hmm.
Mike, in 2008, you ended up with a slight gain.
That's right.
Yeah, slight gain in 2008, and you know, there was one fella who I was giving advice to that had oh gosh, he had about 350K in mutual funds and about 325K doing radioactive profit machines. You know what his losses were for that year? 4%, or actually a little less than 4%. A little less than 4%. His mutual funds lost over 40%.
Mm-hmm.
Okay, so having 96 of his marbles still left in one of his sacks, as it were, he was able to take advantage of the bottom of the market. But that stuff that he kept in the mutual funds, I think it's only just beginning to recover. Only now, 3 years later.
Right.
So something else. Okay, Mike, we had 36% say I'd be ahead by $1,000 to $5,000. 24% would have saved or made $5,000 to $10,000, and 12% this information would have made $10,000 worth of difference. We had 12% that said I don't get it. Okay, and I understand that. I understand that. We're gonna help you get it, okay? But you know, 88% of us understand that forcing yourself not to lose too much when you are wrong, because you're going to be wrong. Forcing yourself not to lose too much when you're wrong makes it so that you have money to play in the winning place, and it's kind of cool. Okay? All right, so we're going to help that 12%. We're going to help them get it. Mike, when we set up a married put position, stock goes up. Okay, or even sometimes, in some cases, with the income methods and so forth, if it travels sideways or even goes down, you can make money.
Mm-hmm.
On the other hand, you can't lose too much if you do this the way that it's prescribed. Okay, and that's the deal. That's what's kind of cool. Now, we already put a number on it, but in Colorado Springs, about this time last year, I did one of these lectures live, and instead of doing an electronic poll like we're doing, I just went around the room, and one fellow raised his hand and he says, try $30,000. And I said, good Lord, you would have saved $30,000 last year if you had done my technique. He says, well, actually, I would have saved $30,000 in a single trade last year if I'd have been doing your technique. So needless to say, he picked up the blueprint that night. And we've remained in communication, by the way. He's doing very well. Let's compare owning 3 positions. I'm just going to go ahead and make a comparison here just before we show the riskless spread trades, okay? All right, straight stock, covered call, married put. Okay, now, if your stock goes up 20%, what's your gain with straight stock ownership?
Well, you're going to make 20%, Kurt. Again, not including commissions. Let's just say 20%.
Yeah, okay. And a covered call would make less. Let's be real generous and say, let's say that it's 5% worth of both premium and capital gain. Now, is the married put going to make less? Yes or no?
Yes, it is. You did pay some capital. You did hedge the position by buying an insurance policy. You're not going to make the full 20%.
That's right. Okay, so we're going to end up making less. I'm going to say, in this case, 15%, although that could vary. It could be 12% or it could be 18%. There have been some cases, because of my applying income methods, there have been some cases where I've made more money with the radioactive profit machine than the stock itself actually went up. And we'll see the money net a little bit later on. But let's just go with this, okay? 20% gain with the stock, 5% gain with the covered call. Married put gains less in the straight stock, but more than the covered call. Now, all 3 of these won, right?
Yes, all winners.
And all 3 of these could, yeah, and all 3 of them could have been done on the same stock. All right, but let's put it into a new play. All right, let's take our winnings. We go to new play. Now, if our stock is down 20%, all right, why then the straight stock play loses 20%. Okay, the covered call is going to lose less. Let's be real generous and say that the premium we received was 5% of the overall deal, and so we're going to lose only 15% instead of 20. Okay, and then the married put trade loses only 5% because of the way that we set this up. Now I know I showed 6% and 5.4% maximum at risk, but Mike, am I in control of where the stock goes? I'm really not, am I?
No, we don't control where the stock is going to go. We do not have control over that.
No, but I am in control of whether or not I decide to stay in that stock and put combination, and I'm in control of whether or not I do an adjustment. And so those things can mitigate the risk. I can take it down to 5%. Even if I've got a 6% at-risk deal and I decide to close it early, I'm not going to realize the full 6% loss, am I?
No, not at all.
No, it's going to be more like 5%. Okay, so here's the deal. All right, we had these 3 places in place where the stock made 20% and then the stock lost 20%. The straight stock position actually loses money. You would think that if you make 20% and then lose 20%, you'd be in the same place, right?
Right. Yeah, it's just a wash, but it's not. That's not how math works.
Right. Yeah, it's just a wash. That's right. If I had $100 and made 20% on it, I'd have $120. And if I had $120 and lost 20%, 20% of $120 is $24. I'm going to be behind the 8 ball here. Okay, so that's the way the math really works. Now, it actually is worse in the case of the covered call, because if we rode the market up and rode the market down and we were mixing options with our stock, well, doing it this way cut our winners short and let our losers run, so actually would do worse. Okay, on the other hand, with the married put would make less on the way up, but it would make a lot less of a loss on the way down. Okay, so mixing this option with our stock set it up so that we cut our losers short, let our winners run. Kind of cool. All right, out of the three plays, the only one that made it through this market with a positive result was the one that limited risk on the downside. Okay, that's the only one that did it. Okay, so Mike, again, I'm going to say that the foundation of radioactive trading is to begin with forcing yourself not to take too big of a risk. If you force yourself not to take too big of a risk, and even if you take more modest gains, you'll do well. Okay? All right, so we're going to talk about what's different now. Mike, does this same fit?
Yeah, we have a system set up now using this technique where we're forced into a position that cuts our losers short and lets our winners run.
Right. I know that some folks joined us after we set the ground rules, and the ground rules were going to be that, hey, we've anticipated most of the questions, so please don't ask too many questions so Mike can stay focused with me. But we are going to answer any questions that you jot down that we haven't answered by way of the presentation, okay? All right. So cut your losers short, let your winners run. This fits now, okay? And let's do just a quick review here, Mike, of just this amount of information. Okay, we are going to show the riskless spread trades, but I wanted to show a quick review. Looking back over the 12 months, this was our baseline reading. Looking back over the last 12 months, are you happy with your trading results? Nobody said, yes, I made piles of money. 40% said, yeah, I'm happy, but I could stand to be happier. And 50% said mixed emotions. You know, the losers have taken down the winners. Or 10% said unhappy. I would rather take a physical beating than the beating I'm taking in the market. Okay, so that was our baseline. And then we took this read here, and now we're at 50% saying, yes, I'm very happy. We had nobody in that category to begin with. Nobody was in that category. Nobody was in that, I'm very happy. All right, 29% had said no or mixed emotions, but would be happy. 5% had a losing year, but this would have made the difference. And 13% would still probably have lost money, but not lost as much. Okay, so radioactive trading benefited 97% of the crowd. And the 3% that never had a loss of over 6% and still ended up losing money in a bull market, You are swing trading, okay? You're trying to expect profits too quickly, not giving it a chance to mature. And I'm going to prescribe that you stop trading right now. Stop trading right now and paper trade this, okay, and see if I'm not right, okay? Stop trading right now. If you're losing money and you're keeping your losses that tightly controlled, you're getting out of positions way too early, okay? All right, so this is what RadioActive Trading has done for us so far. Also, let's take a look at the dollars, okay? Care to put a dollar down on what you would have done? 12% didn't get it. Okay, but 16% would have paid for the blueprint, $350. 36% would be ahead by 1,000 to 5,000. 24%, 5,000 to 10,000, and 12% of you, this information would have made $10,000 worth of difference. Isn't that something? Okay. Very good. Okay. Well, Mike, we've got more to show. I don't know if I want to share the Trade Simulator tool right now. How's our time doing?
We're at 12:56.
12:56. We better skip this, okay? I'm going to skip this. Let me just summarize what's going to happen now, and I'll just ask you to go after the webinar. Go to RadioActiveTrading.com and test this out for yourself. Okay. The Trade Simulator will show you that it's possible to win less often and shoot for lower gains and still make money. If you do it right. If you keep your losses low enough, you can set your target at a more modest level, your winning target at a more modest level when you get out of a trade, and you can actually be wrong more often than you're right and still make money, actually make piles of money. Okay, so that's something to check out. Okay, so what else is different now? What's different now, we already showed you that if you begin with a setup that limits your risk down to 6% or less, that you're willing to make money. Actually, 97% of you told me that you would have a better year. Okay? So, now for the adjustments, which are mostly riskless spread trades. I call these riskless spread trades income methods because they're almost always done at a credit. Okay? And sometimes, however, they can be done at a debit, but with the idea of guaranteeing a higher payout in the future. Okay? So, what's everybody saying, Mike?
Where are the three methods?
Yeah. Do you really expect us to believe that you can do a spread trade that has zero risk? Okay, I'm going to show you one real fast. It makes me grin, Mike, when I see folks waiting forever on a limit order and trying to chase the market and trying to shave 5 cents out of the bid-ask spread. And what they could do is have a much better edge by using a spread trade. Okay. All right. So let's take a look at a recent example that I sent. Whoops. That's repeating. That didn't right. Okay. Here we are. Now the caption at the top changed, and it's because I'm going to show you a little 5-slide sequence out of stuff that I'm reserving for my Fission members. We're actually going to rename Fission Fusion and add a whole bunch of benefits and a whole bunch of features that I can't really go into right now, but this is part of our free education that is a part of your Fission membership, and I'm just going to show 5 slides out of one of several presentations. Okay, but this is Humana Resources. Now, Mike, you can see this is a married put. I have $940 at risk, okay, or 6.7%. Okay, now we're going to take that and combine that with a bear call spread. Now a bear call spread is going to risk, in very many cases, it risks a lot more money than it takes in, right?
Well, of course, the difference in strike prices is going to be a factor higher than the amount of total profit you can make. Maybe 5 times as much, maybe 10 times as much, depending on the position.
Right. This was a move that I made just about a month ago with Humana that I wanted to document for posterity. Okay. Actually, I've documented a lot of things, but here we are selling 2 April 67.50 calls, and at the same time buying 2 April $70 calls. So the spread is a $2.50 spread, and since it's 2 contracts, and I'm taking 95 cents in and paying 45 cents out, what it is 50 cents times 2 times 100, it's $100 credit. Got it?
Mm-hmm.
Okay. But what's the problem with taking $100?
Well, you're still risking, well, technically you're risking 500, but in reality you're risking 400. You're risking 4 times as much because you'll still keep that dollar net credit regardless of what happens, but on the straight bear call credit spread, if the stock is trading above $70, you have to cover that $250 difference in the strike prices.
That's right. Okay, so if the stock goes up, I'm going to get hurt. I'm going to be on the hook here for $5, right? Or since I've received $1 already, it's going to be a total of $4 that I've got to pay out. Okay, but guess what? What if I was to combine the two positions? Okay, in the graph on the following page, all right, the two positions are combined. Now, do you remember where I showed that the Mary put had 940 at risk? It had 940, which was 6.7%.
Correct.
Do you remember that? Okay. Maybe I should go back just a few pages just so everybody sees that one again. Okay, we have 940 at risk, or 6.7%, and we've got this straight-up hockey stick graph still having an unlimited upside. Okay? All right. Now, after putting this on at the same time, when I combine both of them, we take down the 940 to 840. We're going to reduce the risk to 840. The bear call spread has a an at-risk amount of $400, but guess what? In order for that bear call spread to go against me, the stock has to gain enough to more than cancel that loss. Okay, and it won't be a loss because look, see that check mark? Let's take a look again. There's that check mark. This is what happens when the stock gets to $70. If the stock gets to $70, my bear call spread goes completely against me, but I'm in the green, aren't I? I'm making money. And if the stock continues going up like it did, in fact, okay, it did go up above 70, then the $70 long call takes over, and I'm still have an unlimited upside. Okay, so that's one way to do a riskless spread. Now, what happens if that spread closes worthless? What if it expires worthless?
Well, you still have the stock. You still have the put insuring the position. You've lowered your initial investment amount, so you have a lower total risk on the position, and you can continue to do this spread or another of the 10 different income methods that are discussed in the blueprint.
That's right. Okay, so instead of trying to get a 5% edge by doing my limit orders and so forth, which I still do, okay, but I'm not going to sit and watch it all day and see if it fills. I'm just going to let's try and get between the bid and the ask. Here we go. I didn't take it. All right, that's fine. I'll pay the whole ask. I mean, that's really how concerned I am about it, because I know that I can take a much bigger edge by nesting one trade within another like this. I took out all the risk of the bear call spread by doing it in the context of owning the stock. And I took out $100 of the risk of the Mary put by doing the bear call spread in the first place. And oh, by the way, the bear call spread expires much sooner than the put option does, so I can do this repetitively. Okay? All right, so the income methods are applied usually at a credit to reduce your overall cost basis. Now, I'm going to show you another couple of spread trades here, Mike. I applied a lot of income methods to Lulu. There's two in particular I want to show you. All right, so here I am in Lulu with a net cost basis. This is after I did a couple of income methods. I have a net cost basis of $17,038, all right? And my puts are the $80 puts, so I'm guaranteed $16,000 back. So my maximum risk is about 1% of a 100K portfolio, right? Kind of the guidelines we talked about. My maximum risk is 6.1%, all right? Which if I close it before August or June, if I close it before June, it would definitely be less than 6% loss. Okay, all right. Now, let's go on. I use income method number 5, and here's how it was done. In March, I bought to open an April $85 call for $5.60. Now that adds to my cost basis, doesn't it, buying that call?
Right, you've added to the total cost basis of the $17,000 you had in place.
Right, okay, so I'm long 200 shares of stock, and I'm protected by put options, and now I'm also long a call. Well, I don't like having to pay for that. So what I'm going to do is I'm going to sell 2 April $90 calls to finance it. Now those $90 calls were trading at $290 on the bid. Okay, and so I'm able to pick up $580. All right, and that finances the $560 purchase that I made. So I have not really impressive, but it's something, right?
It does lower the cost base of the position,
Hello?
yes.
Yeah, I got a net credit, and that lowered the cost base of the position. Okay, now here's what's interesting about a ratio call spread when it's done by itself. You're buying one and selling 2 calls. Well, it actually is done at a credit. Okay, you can see here where I collected 20 cents on the front end, but there's a problem. There's an infinite maximum risk. What's the infinite maximum risk all about?
Well, it's on the upside because you're short more calls than you have purchased. So with just that setup of the ratio call spread, you technically have one part of it that's carrying the infinite risk of a naked call.
Right. Okay. But remember, again, I'm doing this in the context of a married put. Now, here's the deal. I collect a premium to put this on. As the stock goes up, if it travels up toward 90, that's my peak, I'm going to catch a little bit more income. Okay? Even if it goes up past 90, I will be able to cash in a little bit more. I'll show you exactly how I did that. Okay? This is something that we did here on last expiration Friday. Okay, the management was like this. Okay, when you are in the context of owning the 200 shares of stock, all right, I opened one long call against Lulu. Okay, bought 1 long call, sold 2 short calls, sold 2 calls against the 200 shares of stock. Now that pulled in the 20 cents that I showed already. Right, pulled in 20 cents, and it's like I have this situation. It's like I have a bull call spread. This is what my spread traders are going to see. A bull call spread with 1 long $85 call and 1 short $90 call. And it's like I also financed that bull call spread by way of selling another let me start over. Selling another covered call at the $90 strike. See how that makes sense there, Mike? I've got a short call here, a short call there, and a long call here.
Okay, yep.
What happened? What am I left with if I close this $90 covered call? What am I left with?
We are left with a long call and the married put position.
Right, and a short call also. I'm going to have a bull call spread left over. Make sense? Okay. All right. So on expiration Friday, Lulu is trading at $93, exactly what you don't want to see if you sell a covered call. You don't want to have to pay more to manage that call if you want to keep your stock. You don't want to have to pay more than you received. Remember, I got $2.90 for selling a covered call. Well, look at what happens, okay? I'm going to go ahead and send $3.50 to close that April 90 call. That's what I did on expiration Friday last week, okay? Now, oops, after doing that, remember I had received a premium of 20 cents. Now my total expenditure there is $3.30. Okay, it looks like I've spent money. But here's the thing, I've spent money and at the same time freed up a bull call spread that's in the money. You see, the stock is at 93 bucks. Is my bull call spread going to return the maximum amount that it could?
Yeah, if the stock's trading above the strike price, if it's trading above $90, you'll get out the 5 points from that bull call spread.
Right. Okay. So what happens is I've spent $3.30. I've received $5. In the middle of the night, what happens is my broker buys 100 shares at 85 because I've got an in-the-money call, and he sells 100 shares at 90 because I'm assigned at that price. So I end up making the whole $5 credit. So here's the deal. I end up making $1.70 for sitting on the stock and waiting. And by the way, the stock has also gone up. So let's review that, okay? Shares were trading at 865 when I put on the income method number 5 play. it went up by about $5. The stock went up by about $5, but I took zero risk. I took in a credit on the front end, and then when it had gone past the strike price, I got paid more to keep the stock. That's kind of backwards of what they do with covered calls, right? If you want to if you want to own the stock, you've got to pay the piper, right?
If it moves up and you want to keep the stock, you have to pay a little bit more to close your obligation and move it up.
Right. Here's the deal. I got paid to own it for that period of time, and got to hang on to it. So that's kind of cool. All right. So the money net also left the upside open. Let's take a look at the graph. Remember how we combined the graph with the bear call spread and the married puts? Well, here's what the combined graph looks like with Lulu when you are long one call, short two calls, and long $200. You still have an unlimited upside potential. So that was kind of the deal. Okay, so that's another riskless spread trade. Mike, I want to show one more, and do we have the time for me to show one more?
We're at
What time is it now?
We're at 111, 112.
I better make this fast. Okay, bulletproofing. Income method number 4. Income method number 4 actually is done at a debit. Now that Lulu has risen above its strike price of $80, okay, actually I did this before I did income method number 5, but for the sake of the presentation I wanted to show it in reverse order. Okay, the June put had gone down in value because the stock had gone up, right?
That's right.
Right, but then again, so have all the other puts. So how can I use that to my advantage? Let's take a look at this, Mike. Here's another spread trade. My initial purchase of Lulu, my cost basis is $70.09. The June $80 put, my original expenditure for that was $15.10. Now that the stock is way over 80, all right, now it's like 100 now. Last time I looked this morning, it was over 100. Okay, but when it was passing 80, that put had come down in value by $10. It was $5.10. But check this out. I'm going to swap them. I'm going to sell that for $5.10, and at the same time buy the other higher up strike for $10.10. Now looking at just this spread, how much am I spending?
$5.
$5, right? Yeah, I'm exchanging the $5.10 for the $10.10, so I'm spending $5, but I'm raising my strike price by $10. Where I come from, that's trading $5 for $10. That's a good trade. And Mike, I still actually have an unlimited upside, but no possibility of losing. Actually, right now, I am in negative 4.5%, negative 4.5% with Lulu. Can't possibly lose, but it's very likely that that'll end up making a lot more than 4.5%. Okay. All right. So the income methods are used to reduce the gap. All right. And then when we reduce our gap to less than 0, we're bulletproof. We can't possibly lose. And that's the status of about half of my stocks right now in the fish and trading portfolio. Okay, now let's go ahead and open it up to a couple of questions, okay? I'm going to say don't pick stocks, pick stops, but especially this trade that we just showed, don't time trades, trade time. These spread trades were actually done not so much anticipating what the stock may do, but putting ourselves in a position that if the stock did something, it would be better. Or responding to what the stock has already done in the case of income method number 4. Okay, and what should I do now? Mike, let's run another poll. Do you have some questions that are coming through?
Yeah, we're almost out of time. I've answered most of them, but you can feel free to address one or two.
Okay. Any in particular that are real good?
Are long calls the same as married puts?
No. No, a long call is not identical to a married put. When I lectured at MIT, I had PhDs follow me into the bathroom with this. Okay, they're like, "What?" And because that's what's out there. But the fact is, a married put is different than a long call. Okay, put it this way: if you placed an order for a married put position, and instead you were filled with a long call, would you be happy? I mean, it's the same, right? Mike, would you be happy?
No, I wouldn't. And a lot of people say, well, it's the same but better. Well, how can something be the same but better? There's no such thing.
All right, here's the deal. What folks are leaving out of that equation is they're leaving out the capital that it takes to buy the stock. And yes, I understand that it takes capital to buy the stock, but remember, the whole point of the put option.
Oh, Kurt, I think your sound cut out, unfortunately. I don't know if you guys can still hear me because it sounds like Kurt's sound has dipped out. But essentially, the real answer is that they're not the same. Oh, there you go. Now you're good. Mm-hmm.
Oh, okay. Yeah, I wanted to finish this line of thought. Okay, because it's really big stuff. There is a out there that long calls are the same as a married put position. It is not so. Mike, if you lose 50% of your capital, how much do you have to make on your following trades to get back to even?
Oh, 100%.
100%. You have to double your money,
mm-hmm.
right? You have to take that 50% that's left and double it, and then you'll just be where you started. Okay. On the other hand, if you lose like 5%, how much does it take to get back to square one?
Well, you'd think it's 10%, but it's not. You only need about a 5.2% increase to get back, to break even.
Yeah. And my trading record looks like that. I have lots of 5.2% wins. I have lots of wins that are higher than that. All right, but I don't have very many. Well, shoot, it's been since 2002 that I had a 100% win.
Mm-hmm.
All right, it's been a long time since I had a 100% win. All right, doubled my money. And but the thing is, when I have doubled my money, it's been with the whole amount in consideration, not a tiny bit. All right, when you trade a long call, the tendency is to overtrade. Here's how to honestly make a married put equivalent to a long call. Put as much as you would normally spend on the stock itself on deposit in an account that pays risk-free interest. Okay, put that much aside and then buy your call, and then you will have an equivalent position. You'll have an exactly equivalent position. But a lot of folks ignore that. They think that because the risk-reward graph looks similar, that it's the same thing. It's not. Okay, you can get in trouble. All right. So I've shown you what the real problem is. We've seen why it's gone unsolved. You've got a viable solution now, and you can see the difference. I'm going to ask. Oh, I didn't close this poll. Go ahead and share that poll. Mike, number one answer here was the possibility of being bulletproof. What two things do you like about radioactive trading? Possibility of being bulletproof. Number one. Number two, taking income by way of spread trades. Yeah, that introduced no risk. Okay, and then third place, the opportunity to adjust my risk and take income. Pretty cool. All right, final poll, Mike. I'm just going to run this, and we'll put up the offer for the blueprint. Okay, I just want to know what y'all want to know more about next. Yeah. Wow, there's lots of questions here. Mike, did you want to share any others of these?
No, I unfortunately I think we're out of time. I'd love to go through them all, but we are out of time, and we need to get to the promotion and be respectful of people's time that came in, because we did mention we were only going to be here till about 1:15. We're already past that.
Okay, good. Okay, very good. I apologize, folks. We are 4 minutes past the hour. Let me close that poll. Share the results. Okay, number one winner, let's hear the offer for the blueprint. So I'll go ahead and do that. And as far as finding these kinds of trades, there is a resource on Radioactive Trading on the Radioactive Trading website called, well, it's a free subscription to Power Options, free 2-week preview of Power Options. That's how I find these kinds of trades. Okay. All right. So here's here's how to get the blueprint, okay? If you already own the blueprint, 2% of our audience said that they already own the blueprint. I'm going to say use support, okay, because the blueprint comes with support. You can mail unlimited questions to us, and we'll answer you in a big hurry. As far as how to find these kinds of trees, Power Options has the best solutions, and I'm going to send this link out to you. It's www.poweropt.com. Whoops. Yep. /RAT. All right, I've just sent that to the audience. If you want to pick up 2 free weeks of Power Options and have some conversations with Mike about what he's doing with radioactive trading, that's the best solution. Okay. All right. Now, as far as the blueprint, 70% of you wanted to know the offer, so let me go ahead and give you that offer. Okay. It's what you get, what it will cost, and what you risk. What you get is 250 pages of instruction on limited risk, high potential return trading.
Mm-hmm.
All 10 income method adjustments. I showed 3 very briefly. Okay. There's also 3 bonuses. Oh, and by the way, it's also what's important with those income methods is also how to manage those adjustments. Okay. 3 bonuses. The quick action guide, take you from using just regular plain vanilla covered calls and turn them in.
I'm sorry. I apologize for cutting you off. Do you want to close the poll there and show the slide that you're on so people...
Oh, yeah, I'm sorry about that, folks. I was just sort of running through these slides here. Thank you. And you couldn't see them. That's my fault. Okay. The Foundations of Radioactive Trading CD will teach you how to trade multiple positions at a time and to keep your risk down to 1% per trade. And 1 free month of Power Options. That's what's included. Okay. And then here's what it'll cost. It's $339 plus shipping. It's $11 in the U.S. and it's more internationally. I don't know how much more. It depends on where you're calling
41 typically. It's $41 typically to UK, Australia, Asia, and South America. We
have some folks today from Denmark, Belgium, Australia, and the UK. I looked before the bell here. What if that $339 investment were a married put? Well, then here's the deal. The most you could risk is $339, right? And the most that you could make is unlimited. But what if we were to bulletproof it? How would we do that, Mike?
Well, to bulletproof, you need a guarantee. You need a guarantee riskless investment.
Right. Okay. All right. So if you get the blueprint today, you can keep those gifts, but it is free. If you decide that you want to return it, we'll 100% refund your money. Okay. All right. Now let me go ahead and send you out that link. Okay. It's www.radioactivetrading.com. Okay. And if you go to that link there, whoops, I messed up. That says radioactiver. Let me do that again. That link is not valid. Hang on. Okay, there's a good link. Okay. www.radioactivetrading.com, and it's $339, and you have 0 risk, so kind of a good deal. Alrighty, sir. Sounds like you're still answering questions. I'm going to look over these guys. I'm going to maybe turn off the sound and stuff, but I'd like to look over them. Folks, if there's a question that was not answered by Mike to your satisfaction, or you just thought of the question too late, after we hang up, go ahead and send it to us at support@radioactivetrading.com. We'd be very happy to answer any questions you have about the blueprint, about the income methods that we showed today, just ones we showed today, and the setup. Okay. All right, Mike. Am I forgetting anything?
No, I think that's it. We'll see you next Tuesday at 12 noon Eastern Time. And if anyone's interested, if you're available this afternoon, I am hosting an open discussion presentation today at 4:30, and you can sign up for that both on Power Options and Radioactive Trading. Now, the open discussion presentation is just, you feel free to bring your questions. I don't have any planned material. We just host questions for Power Options customers and radioactive traders, but I won't go in depth into discussion of radioactive trading and certain income methods because it's not fair to the people who attend that webinar who've bought the blueprint, because there may be several people there who haven't. So I can discuss general questions about some of the techniques that we've, discussed today during that open discussion presentation, but I won't go in depth to it because it's not fair for the entire audience.
Right. Mike, we will be doing, not this Thursday, but the following Thursday, we'll be doing a special webinar for Blueprint owners only. And I showed a couple of slides from it today, so very good. Okay, Mike, I'm going to leave this up. I'm going to shut down the sound. I'm looking at those questions and so forth, but right now I'm going to formally close. I want to thank everybody for coming. I want to thank you too, Mike. So we'll see you next Tuesday, and bye for now. Happy trading.
Take care, everyone.